After a generally positive earnings season, but mixed economic data, investors were left hanging on to political decisions. Initial estimates for Eurozone advanced PMI indicators suggested the situation was stabilizing. Manufacturing is improving, while services are slightly less buoyant. On the political front, Donald Trump reiterated threats that he would increase customs tariffs on Chinese imports if no agreement were to be reached. Meanwhile, Washington's attitude to the Hong Kong unrest could weigh on talks, leaving visibility low on the outcome. China's growth is suffering from the uncertainty, and its central bank cut its benchmark one-year rate in an attempt to boost bank loans. In the UK, the TV debate between Boris Johnson and Jeremy Corbyn was tight. We will have to wait for the impact on opinion polls, which for the moment showed the Conservatives well ahead of the others. There has been more talk of a new Brexit referendum should Jeremy Corbyn's Labour Party win. Elsewhere, the FOMC minutes confirmed that there would be a pause in the rate-cutting cycle unless the economy took a big turn for the worse. In contrast, the Bank of Japan's governor said he could go further with another cut to benchmark rates, even if they were already in negative territory. The ECB's new head, Christine Lagarde, said that support from fiscal policy was needed to top up monetary policy efforts. Essentially, central banks are still scrutinizing economic data and are ready to intervene if things get worse. Equity and bond markets trod water over the week and continued to keep an eye on US-China talks. Equity markets consolidated slightly as investors remained focused on developments in the ongoing US-China trade talks. Tensions increased after Donald Trump threatened to increase tariffs on Chinese imports if there were no deal, and the U.S. Senate approved a bill in favor of Hong Kong's autonomy. This only increased risk aversion, but sentiment stabilized on news from China that the U.S. was prepared to put back tariffs that were scheduled to come into force on December 15th. Cyclicals were hit hardest, including financials, as yields on French 10-year bonds fell back firmly into negative territory. Autos also came under attack as Volkswagen followed Daimler in revising down expected market conditions for 2020. Continental provided more details on its Transformation 2028 plan, which will cut 5,500 jobs out of the total workforce of 240,000. The market was unconvinced. At the Dubai Air Show, Airbus unveiled two major orders for $30 billion in total and a partnership with EasyJet to develop hybrid planes. Sanofi gained on expectations that it might spin off its consumer division. The new CEO had already done the same for Alcon in a drive to refocus on core businesses, a move which also involved disposing of a number of generic drugs. Lottery company La Française des Jeux had a very successful first day of trading after heavy IPO demand. ThyssenKrupp plunged after the group reported a 76% plunge in operating profits and decided to pass on this year's dividend. In company transformation news, Reuters said LVMH was prepared to sweeten its bid for Tiffany. Euronext also confirmed that it was in talks with the Madrid Stock Exchange to counter SIX Group's bid. The S&P 500 was down 0.5% and the Nasdaq 0.6% lower for this week as of last Thursday's close. With no major macroeconomic events for investors to chew on, market movements tracked developments in the talks on a Phase 1 agreement between the US and China. Hong Kong unrest rose a notch, and the US Congress approved a rights bill for the territory, only increasing tension with Beijing. Meanwhile, initial jobless claims came in at 227,000, or more than the 218,000 expected. Moreover, the Philly Fed index for November hit 10.4, or higher than expectations of 7. The latest FOMC minutes showed the Fed upbeat on U.S. growth while acknowledging that there were still serious downside risks. The message was that monetary policy should be attuned to this situation. Japanese stocks edged lower on profit-taking amid growing concerns over the worsening Hong Kong situation and support from the U.S. Congress for the rights of citizens in the territory. Investors fretted that all this would be bad for the U.S.-China trade talks. The Topix lost 0.43% for the week. Economy-sensitive sectors such as semiconductors, which had been leading the market on expectations for an initial partial agreement, reversed direction, affecting companies like Mitsubishi Chemical and Tokyo Electron. Life assurance stocks like Dai-ichi Life Holding and T&D Holdings sank on fears that interest rates would fall. In contrast, pharmaceutical stocks such as Ono Pharmaceutical and Eisai outperformed. In the IT sector, SoftBank's Yahoo Japan, now Z Holdings, and Naver's Line Corp reached a basic merger agreement aimed at becoming a winning platform in Asia. Elsewhere, October convenience store like-for-like sales unexpectedly rose 1.8% despite a VAT hike. This was due to a newly introduced cashless electronic settlement system with consumption point rewards. The MSCI Emerging Markets was down 0.4% as at Thursday's close, despite signs of easing from China. The PBOC cut its 7-day reverse repo rate by 5 basis points for the first time since 2015 and also lowered the loan prime rate by 5 basis points. Markets moved back into risk-off mode in Asia after the U.S. Senate passed the Hong Kong Human Rights and Democracy Act, triggering warnings of retaliation from the Chinese Ministry of Foreign Affairs. President Xi Jinping also stressed the need for equal treatment in any Phase 1 trade deal. In the rest of the news, Ageas announced a tender for holders of its fresh securities. They are expected to receive 56%, up 3%, subject to early consent. That's all for today. Thank you for watching. Subscribe to our channel to track the market pulse and get the latest economic data. Good luck trading.